For the last 2 episodes, we've shown you companies where the profit on the page didn't match the cash in the bank, a reversal that vanished under scrutiny, a balance sheet propped up by new shares instead of new earnings. Today, we're looking at a company that grew revenue by 150% in a single year. Naturally, the first instinct is suspicion. Big jumps like that usually hide something. But this time, when we followed the cash, it was actually there. More than there, in fact. The company generated more cash than it reported in profit. No new shares issued, no mysterious liabilities, no auditor warnings. So is this the rare one? The company that's actually as good as it looks? Or is there still a catch we haven't found yet? By the end of this video, we'll know. Let's go behind the numbers.
Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required. Today, we're analyzing the Initiates Plc's audited financial statements for the year ended 31 December 2025, with the stock trading at 30 Naira.
Let's begin with the business itself. Is the underlying business becoming stronger? For the Initiates Plc, the answer initially looks straightforward. The Initiates Plc isn't a household name, but it's been quietly listed on the Nigerian exchange since 2016. Its business is waste management, e-waste disposal, and industrial cleaning, including decontamination work for the oil and gas sector. It also holds a small stake in a sister operation in Uganda, giving it a modest international income stream. Unlike many companies that grow through acquisitions or financial engineering, the Initiates appears to have expanded by growing its operations, and the numbers immediately reflect that.
Revenue climbed from 4.66 billion Naira to 11.70 billion Naira. That's growth of almost 151% in just 1 year. For an established services company, that's an extraordinary increase. Just as encouraging, profit grew almost in lockstep with revenue. Profit after tax grew from 1.38 billion Naira in 2024 to 3.39 billion Naira in 2025, a growth of plus 145.6%. This is exactly what investors hope to see. Revenue didn't grow while profit stood still, nor did profit rise while sales barely moved. The two grew together, suggesting that the business expanded in a meaningful way.
Based on these headline numbers alone, the Initiates appears to be a much stronger company than it was a year ago. But headline numbers can be deceptive. Growing quickly is one thing. Growing well is something else entirely. Revenue increased by more than 150% in a single year. That's an extraordinary result. It's also unusual. The financial statements don't tell us whether this came from a broad expansion of recurring business or from a small number of unusually large contracts. That's an important distinction because investors aren't buying last year's growth. They're buying the company's ability to repeat it. So before we celebrate these results, we need to ask a more important question. Can this improvement actually be trusted? Here's how to answer that. Whenever revenue jumps this fast, the next move is always the same. Check the margins, then check the cash. We'll start with the margins. Margin is simply how many kobo of profits survive out of every Naira that comes in the door. The higher the margin, the more efficiently a business turns sales into actual profit. Gross margin sat at 53%. Operating margin, 42%. Net margin, 29%. All three margins slipped slightly. Gross margin eased by just over 1 percentage point. Operating margin declined by around 3.5 percentage points. Net margin was virtually unchanged. Normally, falling margins deserve attention because they can signal that costs are beginning to outpace revenue. But context matters. Revenue expanded by more than 150%. Yet, despite operating at a much larger scale, the company still kept almost 29% of its revenue as profit after tax, while maintaining gross margins above 50% and operating margins above 40%. Those are exceptionally healthy profitability levels. The slight margin compression is something investors should continue to monitor in future reports. But on this year's evidence, it isn't large enough to undermine the broader picture of a business that managed rapid expansion without sacrificing its underlying profitability. Healthy margins tell you a business is efficient. They don't tell you where the profit actually came from. So what actually produced this year's profit? For companies we've analyzed on this channel before, the answer often included foreign exchange gains, accounting reversals, or other non-recurring income. For the Initiates Plc, the report tells a different story. Profit before tax rose from approximately 2.05 billion naira to 5.07 billion naira. And unlike some turnaround stories, there wasn't a large one-off gain doing the heavy lifting. The only notable new contributor was about 206 million naira in profit from the company's Ugandan associate. That's a welcome addition. But relative to more than 5 billion naira in profit before tax, it isn't large enough to explain the company's outstanding performance. In other words, the business earned its results primarily through its normal operations. Even finance costs moved in the right direction. Finance costs are simply the interest a company pays on borrowed money. All else being equal, lower finance costs mean less of the company's earnings are being absorbed by interest payments. Ordinarily, a business expanding this quickly would expect its financing costs to rise. The Initiates Plc did the opposite. Despite expanding dramatically, finance costs fell from about 80 million naira to 45 million naira. That tells us management wasn't relying on additional borrowing to fund growth. Instead, the company generated higher profits while reducing one of the costs that often weighs on expanding businesses. So far, the evidence points in one direction. The earnings look genuine. But there's one final test that separates accounting profit from economic reality, and that is cash. This test is where the last two companies we looked at ran into trouble. They had profit on paper, but the operating cash flow told a very different story. Businesses can report profits without collecting the money, but cash flow tells us whether customers actually paid. Here's what happened. Operating cash flow came in at 4.78 billion naira, against a reported profit after tax of 3.39 billion. That is a ratio of 141.2%. In plain terms, for every 100 naira of profit this company reported, it actually generated about 141 naira in real cash. That's not a company inflating its numbers. But generating cash is only part of the story. Growing businesses also need to spend money to keep expanding. So the next question is this. After paying for that growth, was there any cash left? That's where free cash flow comes in. Free cash flow is what's left over after a business pays for the investments needed to keep growing, money it can genuinely keep, use to reduce debt, or return to shareholders. When we subtract the $1.72 billion the company invested during the year, it still produced roughly $3.06 billion in free cash flow. The company wasn't surviving on bank loans. It wasn't raising fresh equity from investors. Its growth was being funded by the business itself. Taken together, that's a remarkably clean earnings profile. The profits appear to be operationally driven, they were converted into cash, and that cash was sufficient to fund continued investment while still strengthening the company's financial position. So, can investors trust the improvement? Based on the evidence in these financial statements, yes. This is one of the highest quality earnings profiles we've analyzed so far. No reversal, no tax credit doing the heavy lifting, no mysterious cash gap. After establishing that the Initiates generated genuine profits backed by real cash, the next question is straightforward. Did the people who own the business actually benefit? The answer begins with earnings per share. Earnings per share increased from 155 kobo to 381 kobo. That's growth of almost 146%, almost exactly the same pace as the company's overall profit growth. And there's a very important reason for that. The number of shares in issue didn't change. Unlike companies that boost total profit while simultaneously issuing millions of new shares, the Initiates created more profit without diluting existing shareholders. That means every shareholder participated fully in the company's improved performance. For investors, that's exactly what you want to see. The profits didn't just get bigger. Your share of those profits got bigger too. The same pattern appears when we look at book value. Book value is roughly what would be left for shareholders if the company sold everything it owns and paid off every debt it owes. It's the company's net worth, one share at a time. Book value per share rose from roughly 2 naira 78 kobo to 6 naira 46 kobo, more than doubling. And that increase came entirely from retained profit, not from selling new shares to plug a gap. Shareholders also received a more immediate reward. Management proposed a dividend of 30 kobo per share, up from 10 kobo the previous year. That's a threefold increase. Even after that increase, the company is distributing less than 8% of its earnings as dividends. In other words, management is striking a balance. Shareholders receive a growing cash return today, while the business retains most of its profits to finance future expansion. For a company still growing this rapidly, that's a sensible capital allocation strategy. So, did shareholders actually benefit? Based on this report, the answer is clearly yes. The financial results point in one direction. Shareholders owned a stronger business, earned more per share, and were rewarded with a higher dividend. That could easily be the end of the story. But good investing isn't just about analyzing the business. It's also about paying attention to the people running it. And that's where one small detail deserves investors' attention. During the year, both the chairman and the managing director reduced their personal shareholdings, one by roughly 22%, the other by around 15%. Now, insider selling isn't automatically a red flag. Executives sell shares for many legitimate reasons: tax obligations, diversification, estate planning, or personal liquidity. The financial statements don't tell us why these sales occurred. But when senior executives reduce their stakes during one of the company's strongest financial years, it's a question investors are justified in asking. Not because it changes the numbers, but because understanding management's confidence in the company's future is part of evaluating any long-term investment. Which brings us to the next question. How did management use that stronger financial position? For this, we need to look at the balance sheet. Total assets grew 129%, rising from 5.12 billion naira to 11.73 billion naira. Net assets also more than doubled, reaching $5.75 billion from 2.47 billion naira. Yet, despite that rapid expansion, liquidity remained stable. In other words, the company didn't sacrifice its short-term financial strength while growing the business. That's a reassuring sign. The next question is whether that growth was financed with debt. Again, the evidence is encouraging. A quick note on the terms here. Current liabilities are bills the company owes soon, usually within a year. Non-current liabilities are debts that come due much further out. Non-current liabilities actually declined slightly, while finance costs fell from about 80 million naira to 45 million naira. That's a company funding its own growth, rather than leaning on borrowed money to do it. But there is one item on the balance sheet that deserves continued attention, a balance sheet line called asset in transit. It usually represents equipment or assets the company has purchased, but which have not yet been delivered, installed, or commissioned. It jumped nearly six-fold, from 150 million naira to just over 1 billion naira. It isn't necessarily a problem, it just means the company has already committed the money, but the assets are not yet contributing to revenue. It is important to know exactly what's inside that number and when it's expected to actually start generating revenue rather than just sitting on the balance sheet. Beyond that, the governance picture here is the cleanest of anything we've reviewed. No restated prior year, no late filing penalty, no unexplained liabilities, no related party asset purchases funding a speculative new business line, and no indication of a going concern issue from the auditor. Taken together, that's a relatively reassuring governance profile. It suggests management's operational execution was matched by reasonably transparent financial reporting. So what did management do with the recovery? They expanded the business without placing excessive strain on the balance sheet. They funded growth largely through internally generated cash rather than additional borrowing, and they maintained a clean governance profile while strengthening the company's financial position. That's a strong combination, but none of that answers the question every investor eventually has to ask. Has the market already recognized all of this good news, or does the current share price still offer an attractive opportunity? At the current share price of 30 naira, the answer depends on which number you choose to look at. Let's begin with earnings. Based on this year's earnings, investors are paying about 7 naira 87 kobo for every 1 naira the company earned. For a business that grew revenue by more than 150%,
increased profit by almost 146%, generated more cash than accounting profit, and created all of that growth without issuing additional shares, that isn't an expensive valuation. In fact, it looks surprisingly reasonable. But valuation is never just about earnings. It's also about what investors already own. Remember that book value per share we mentioned earlier, 6 Naira 46 Kobo? Compare that to today's share price of 30 Naira, and the share price is about 4.5 times bigger than the book value. That gap between the two numbers, share price on one side, book value on the other, is what investors call a premium. The bigger the gap, the bigger the premium the market is paying above what the company's own assets say each share is worth on paper. Here, that gap is real. The share price is roughly 4.64 times the book value. At first glance, that might seem expensive, but remember what's sitting underneath that premium. Book value here grew because the company earned and kept its own profit, not because it issued new shares or bought a speculative asset from a related party. A premium built on organically earned value is a very different and more defensible kind of expensive than a premium built on financial engineering, a much stronger foundation for paying that premium in the first place. So, is the Initiates worth buying? Based on these audited financial statements, yes, but with the right expectations. This doesn't look like a distressed turnaround waiting to be rescued. It looks like a fundamentally strong business that has already demonstrated it can convert growth into profits, profits into cash, and cash into shareholder value. At around 7.8 times earnings, the valuation doesn't appear demanding relative to the quality of the business we've just analyzed. That said, investors shouldn't assume a year of extraordinary growth automatically becomes the new normal. The next set of results will be important. If management can show that this year's performance wasn't driven by a small number of exceptional contracts and that the assets currently in transit begin contributing to revenue, the investment case becomes even stronger. So, after 2 episodes of finding the catch, is there one here? Genuinely, the honest answer is not much of one. Having said that, here's my verdict. For new investors, accumulate. At the current price and PE ratio, the Initiates Plc's valuation appears attractive for a company delivering strong revenue growth, high-quality earnings, excellent cash generation, and undiluted shareholder value creation. The main risk isn't the quality of today's business, it's whether this remarkable pace of growth can be sustained. For existing shareholders, hold. Nothing in these audited financial statements suggests the long-term investment case has weakened. In fact, the business appears stronger than it was a year ago. Unless future reports show a significant deterioration in cash generation, profitability, or governance, there is little in this report to justify exiting the investment. Continue monitoring the durability of revenue growth, the large asset in transit balance, and management's insider transactions. But based on the evidence available today, the company's long-term direction remains positive. That's it for the Initiates Plc audited full-year financial statements for the year 2025. If there's one thing to remember from today's analysis, it's this. The best investments aren't simply companies that grow fast. They're companies that turn growth into real cash, real shareholder value, and sustainable long-term returns. The Initiates did exactly that this year. The next challenge is proving it wasn't a one-off. Before we wrap this up, remember, this video is not financial advice. It is for educational purposes only. Always do your own research or consult a licensed financial advisor before making investment decisions. Now, I'd like to hear from you. Would you buy, hold, or avoid the Initiates Plc at today's price? Let me know in the comments below. If you enjoy evidence-based investing without the hype, like this video and subscribe to Behind the Numbers TV. Also, turn on notifications so you never miss our next deep dive into the Nigerian stock market. Because every number tells a story, and together, we'll learn how to read it. See you in the next video. Thanks for watching Behind the Numbers TV.